as we pivot to segment 2, we always want to start with what is happening in those mobility fuels. So for those that have been following us, we've been saying that we were really going to track 2022, but then likely fall below 22 when we start looking at, again, the economic pressure. We've seen the consumer getting hit. We've talked about it in the macroeconomy show. You've seen it likely in your daily lives in terms of some of those pressure points. And that continues to play out here. Now, we do think that some of the drops are a little too aggressive, especially when you start looking at some of the gasoline sides. You know, we've had 80-cent spreads between premium and regular. We've continued to see some of these back and forth. So we will start to see some of that impact, averting a bit, and we will see a little bit more demand. But we went from 14.457 million barrels a day last week to 13.885 in this current report, and will likely bounce something closer to 14, but it's not going to be a huge recovery. You know, maybe it's 14.2, but you can see based on 17, 18, 19, we're still very much below where we have been, and we don't see that changing even as we come out of shoulder season. Distillate had a drop of 1.27 million barrels. We're still above the year on year, but well below the 5-year average. The draws were consistent across pad 1, pad 2, pad 3. You know, imports still remain a bit soft, and it's going to be difficult. And this is why the Atlantic Loop, or when you think about Brazil all the way up to Atlantic Canada through Europe, that whole loop continues to be tight product, especially when you look at some of the arbs between west and east. You know, where Russian product being held off the market is really kind of taking some of that Middle Eastern product that was heading this way and turning it into Asia, leaving us a bit short, which is why even as gasoline prices start to come down faster, especially as full winter grade is priced in, that'll pull down some of those prices. We're going to see diesel prices come down. I'm not saying we aren't. We're just not going to see the same rate of change of pricing in diesel versus gasoline. So then when you start looking at the crack spreads, here you can see that the crack spreads are starting to waffle and come down. For those that have been following us, and if you listened to us in August, we were saying that above 50 was the top. Like, there was no reason to still be there because we saw downside. Now, given the storage situation, we don't see it going back to 30, but we also really don't see it going to 60. It's going to be in this tighter range, and a lot of that is going to be driven based on the slowdown in demand. Now, could demand pivot as we get into a cold winter? Absolutely. And then we'll see that shoot back up. So that's why right now you're kind of in no man's land, and you're wearing a weatherman's hat, which is, in my opinion, not a place I like to be, nor a place I feel comfortable, because it's going to be on whims of what is happening in the weather at this point and what the expectations are for an early winter, late winter, warm winter. It's just, to me, there's no edge, and I'm not looking to play that. I'm looking to find things that I think there's an edge in, or something that we can have more of a directional play where there's a minimal risk, or at least a finite risk with a maximum reward. So then when we start looking at pad 1, here you can see pad 1 distillate continues to be at a massively low level with a huge problem that is going to be consistent. There's no product abroad that can fix this. There's more than enough in pad 3 that could get moved, but the Colonial Pipeline is tapped out. We still have the Jones Act vessel limitations, so that's going to be problematic going forward. Pad 3, as we've been saying, fairly normal. One of the things that we've talked about is the slowdown in exports, which is going to put a bit more into storage. And here you are. And again, we're going to be fairly stable going forward, and that's going to make our percentages, or our comparison to the 5-year average, a bit easier when you look at some of those backdrops. Now, when we start looking at distillate products supplied, one of the things that we've been talking about is it was going to stay below the 5-year average. We had a brief bounce above. Now we're back below. Here you can kind of see where we sit and how things continue to be fairly normal when you look at those different the different levels between the two. And a lot of that is because when you look at market demand index, that flatlining. Here you can see we continue to be on that flat line. We had a little bit of a reprieve, and now a lot of that has gone away and that reprieve was people taking advantage of cheaper shipping, people trying to capture that back to school market. Now that is dissipated, we don't see that level of increase. If anything, it'll likely continue to roll over, especially as the UAW continues to strike. And realistically, they're expanding that strike to now hit bigger pieces, which is going to limit some of that underlying demand. And I think this is a great chart that was put out by FreightWaves, by Craig on Twitter. And you can see where the UAW started their strike and how that's pulled things down. The estimate up front was about 5 to 8%. Here you can see that it's dropped 12%. So you get an idea of some of those impacts. We have seen a bit more go onto rail, and that's going to be an important piece because you have to weigh the two, but rail doesn't take the same level of diesel as trucking. So when you look at this and you see that, metallic and ores up 13%, vehicle parts up, and vehicles and vehicle parts up 9.6%, petroleum products up 9.9%, which again, trying to move that product from point A to point B because it's cheaper than going on to a Jones Act vessel. So you're going to try to rail it where you can. And intermodal has had a little bounce, but if you look at year to date, we're still 8% below year to date. And a lot of this is just pulling off of truck, pulling off of that level, putting more on rail because inventories are elevated when you look at wholesale, when you look at retail. Retail sales are slowing. So there's no impetus for a company to pay extra to get it onto a truck and get it there as quickly as possible. People have time now. And if you have time, you're going to use the cheaper option because the cost is spread across across more volume. You're going to utilize the rail. So then when you start looking at what's coming into the country, you can see that we still remain at the lower end, a bit more normalized in terms of those ebbs and flows. But realistically, we're still at a very, historically speaking, kind of low end of the range. It's still better than the previous year, but remember the previous year we had a huge drop. Now we're not getting that this time. Now it's a bit more normalized, and that drop was you had you still had zero COVID policy. You had a lot of these things happening, and that continues again to have those easier comps. But when you look at the data so far, this is not a huge number when you look at the trucking and into the intermodal front. Now, when we start looking at temperatures, things are getting a bit colder, especially if you start looking at, that Midwest, or if you want to say the Mississippi East continues to get a bit colder. That's why we had a nice little bounce in natural gas. And it's just going to be, as we were saying, we were always cautious about playing it, it's the weather side. October has historically been a very odd month. Especially when you look over the last decade, we've had very warm. October is cold, and they can flip back and forth. 2 weeks ago it was 60, this past weekend, and yesterday was 80. So again, it's difficult to say, but this is just showing that over the next few days, we're going to go back to the 60s, and it's going to be a bit colder than expected, and that's going to be an important one to watch. Everything Midwest and over continues to be above normal. Net, this is a positive for the consumption of natural gas, but these are important things to look at in general. Now, gasoline had a big build of 6.48 million barrels. That now puts us 2.5 million over the 5-year, 19.5 million over the year-on-year. There were builds across the board. Pad 1, Pad 2, Pad 3. Pad 1 had the biggest. And the reason why Pad 1 had the biggest, imports. One of the things that we've been very consistent on is that Europe was going to unload on the East Coast, and that's where we are. The ARB blew open, especially when you looked at some of the different shifts, and you had the adjustment on the winter side, and you had a huge shift in terms of imports. One of the things that we were saying is that we would likely get to 850, 900. This week we got to 918,000 barrels a day. From there, we'll pull back a bit. And a lot of that came in by way of Pad 1 and Pad 5. And Pad 1 continues to be 126,000 above the 5-year. If anything, we see that moving closer to the 5-year average. But then when you look at blending components has had a massive move up, and the move has been a bit stronger on the blending component side, especially from the export market. And blending components was up 5.29 million barrels, and that's actually 7 million over the 5-year average. So gasoline itself is 2.5, but blending components is 7, and that's where we do see some of that pivot, because the spread between regular and premium has blown out. We should see some of that ARB collapse and some of that pressure coming through. And here's just putting into perspective the crack spread. And again, it's a financial crack spread. It is what it is. Here you can see that massive drop and now we are at the lowest point when you go back through 2022 on the crack spread side, which is why, again, you're going to see some of that pressure. And a lot of this is driven not only by the consumer side, but also just the barrels. Barrels are still expensive, and it's getting harder to push that down to the consumer front. Here's the blending component side. You can see we're back to levels that we haven't been at since 2018. When you look at that pivot higher, we're above 2020, 21, 22. And this is what we were saying, is that the comps were going to get easier, and then you were going to get that counter seasonal build, and that's where we are. And that's why we do see some of those price adjustments in general. Now, when we start looking at U.S. regional road congestion, things have gotten a little bit stronger in the Rockies, as well as Pad 2. Pad 1, Pad 3, Pad 5 are kind of floundering a bit in terms of where they are versus the historics. And realistically, we continue to see things remain a bit below that monthly implied gasoline demand. It's going to be at the lower end, especially when you start looking at some of the flows and some of the levels of activity as the consumer continues to pull back a bit. According to GasBuddy, U.S. gasoline demand rose 0.9% from last week and was 1% above the average of the last 4 weeks. And this is, again, counter to what the EIA said. And that's why you have to balance the two, because the EIA essentially said, we're at just over 8 million barrels a day of gasoline demand. And we're saying you're probably closer to 8.4, 8.5. And that's something that GasBuddy is saying. And when you look at TomTom, it's saying something similar, where, and the problem is, and the reason why is because the retail side is holding back on buying what they need from some of these blenders and some of the retail, some of the storage side, because prices are so elevated and there's that arbitrage, and they're like, look, I'm holding back until those prices drop, and then I'll take my full cargoes. And that's what the EIA looks like, where if you look at TomTom, GasBuddy, they're further downstream, and you're seeing kind of that stability, if you will, on that demand front. Now, when we talked about the spread and that difference between gasoline and diesel, our view is that gasoline prices will continue to fall. Diesel prices will fall, but not to the same degree. And that arbitrage, or that alligator mouth between the two, is going to remain, because you still have a huge storage issue with diesel. You don't have that same storage issue with gasoline, and that's the difference. And that's the shift, especially when you look at what OPEC has done, especially Saudi Arabia. They've taken those medium heavy barrels off the market, which is the really good ones for the distillate side. So gasoline prices will come down, but it's also important to look at them in comparison to year on year. You're still at the higher end. It's not like the comps, back and forth. When you looked at the drop in 2022 from that peak down, you had a year-on-year benefit on an inflation calculation. That benefit has dwindled, especially as prices remained here. And if you look at 22 going into the end of last year, you saw a big drop, where we should see something similar. The question is going to be, at a pricing regime of Brent 87, are you going to have something that extreme? And the answer is probably not. Now, this is looking at that EIA data. As we were saying, we do expect it to be higher, closer to where we were in 2020 and 2022. But that's still on a 10-year low. And that's where we continue to show that disconnect between what the market was expecting and what we've been saying. It's like, look, the consumer's struggling, and you're not going to have people that are going to go, on a relaxing drive or something of that nature, just because people don't have the cash right now and they're trying to scrimp wherever they can. Propane, propylene had a small draw of 20,000 barrels. We're still 15 million over the 5-year. If we get a cold winter, it'll help significantly, but you can see we're starting at a very high end, and yes, it'll start to roll over. It always does. It's a seasonal entity, but realistically, the petchem side isn't great. Exports are very robust, but there's more than enough product to fill whatever demand we have in the U.S. and more than enough to cover what we are going to export. So we do see pricing remaining sluggish as storage remains elevated. Jet had a small draw of 320,000 barrels, fairly in line with the 5-year average. You can see that we're a bit on the higher end on demand, which is actually quite normal when you look at some of the flows, which we're going to talk about in a minute. And we do expect demand to be between 1.6 and 1.7 million barrels. 12-week ahead passenger departure schedule. Asia had a nice bounce. A lot of that is because of Golden Week, which kicked off Thursday into Friday. Everything else in Eastern Europe, North America, Western Europe, continues to just normalize as we get into to Thanksgiving. You still have a huge issue with flight delays. As somebody who has traveled recently, I've had my share of delays. So none of this is crazy when you look at some of the demand hits that have rolled out. When you look at passenger travel, in versus 2019, you kind of see how things are a bit stronger and moving towards the higher end of that seasonal peak. And that's something that we do see remaining. On the European side, we will likely get towards 2019 levels. It's just going to be a bit slower. We'll slow down just a bit, but we do see that running into what you can deem as normal. When you look at the open table, you can see that inherently eating out has slowed. We don't see that changing. If anything, we see it getting worse, and a lot of that is just because the first thing people pull back on when they're struggling or when they're trying to cut and increase savings is going to be eating out, and that's why we continue to see that. And I think this speaks closer towards the slowdown in consumer spending really than anything else, which is why we talk about it so much, and we'll continue to talk about it in tomorrow's Econ show. So that's what we have for you on the U.S. In the next segment, we're going to go deeper into the global market and how flows have shifted around the world.